In the last 24 hours, financial markets sent a clear message. Risk is being repriced. Stocks fell, cryptocurrencies collapsed, and volatility surged across multiple asset classes. This move did not start in one market or one region. Selling pressure appeared almost simultaneously across the United States, Asia, and crypto markets, signaling a coordinated shift in investor behavior. US equity markets led the decline. Technology stocks came under heavy pressure as investors questioned earnings growth valuations and forward guidance in a tightening financial environment. High-growth tech names, which had benefited from optimistic expectations, became the primary source of selling. As these stocks fell, broader indices followed. Asian markets extended the sell-off. Weak sentiment carried over overnight, reinforcing the idea that this was not a localized event, but a global shift toward capital preservation. Cryptocurrency markets reacted aggressively. Bitcoin broke below key technical levels, triggering a cascade of selling across the entire crypto complex. After failing to hold above major resistance, Bitcoin dropped rapidly toward the $60,000 area. Buyers stepped in briefly, but the rebound lacked strength. Leverage played a critical role. As prices declined, long positions were forced to close, accelerating losses and amplifying volatility through automated liquidations. Altcoins underperformed Bitcoin, with many assets posting double-digit losses. This divergence highlights declining risk tolerance among traders. Even commodities reflected stress. Silver experienced extreme intraday swings, an unusual signal often associated with disorderly market conditions. When traditionally defensive or industrial commodities show instability, it suggests forced positioning rather than fundamental repricing. This environment is driven by macro uncertainty. Investors are reacting to tighter financial conditions, slowing global growth, and limited policy flexibility. In risk-off phases, capital exits volatile assets first. Stocks, crypto, and high-beta instruments are sold in favor of liquidity and safety. Bitcoin once again moved in correlation with tech stocks. This reinforces its current role as a risk asset rather than an independent hedge. Institutional holders are feeling the impact. Large unrealized losses increase caution, reduce exposure, and feed negative sentiment back into the market. In the short term, markets remain fragile. Without a clear catalyst or stabilization in macro conditions, volatility is likely to persist. Traders are now focused on whether support levels hold and whether volume declines, signaling seller exhaustion. This was not just a crypto crash. It was a global repricing of risk across stocks, crypto, and commodities. For more market breakdowns and clear analysis, don't forget to subscribe to the channel and like the video.